In this video, we'll show you 3 undervalued stocks that could quietly become massive long-term winners while the broader market stays distracted by hype, momentum, and expensive growth names. These are businesses operating in industries the world still desperately needs, trading at valuations that suggest the market may be underestimating their future earnings power. One of these companies sits at the center of a global metals supply chain that modern infrastructure, renewable energy, and industrial production cannot function without. Another operates in a sector tied directly to aging demographics and healthcare demand. And the third is a regional banking business that continues to compound steadily while many investors ignore smaller financial institutions entirely. We're starting with a company that could benefit from one of the most important long-term trends in the global economy, industrial metals demand. The company is Nexa Resources SA, ticker symbol NEXA. Now, when most investors hear the word mining, they immediately think volatility, commodity cycles, and unpredictable profits. But what separates stronger mining businesses from weaker ones is scale, operational diversification, resource quality, and the ability to survive downturns while positioning themselves for the next commodity expansion cycle. And Nexa Resources is interesting because this is not some tiny speculative exploration company hoping to discover a deposit someday. This is an established zinc mining and smelting business with operations spread across South America and exposure to multiple industrial metals markets. That matters because zinc is one of those metals most people rarely think about, but it plays a critical role in the global economy. Zinc is heavily used in galvanizing steel to prevent corrosion. That means infrastructure projects, bridges, buildings, transportation systems, industrial machinery, and manufacturing all rely on zinc in some form. And here is what makes the long-term thesis fascinating. As countries continue rebuilding infrastructure, modernizing power grids, expanding transportation systems, and increasing industrial production, the demand for metals tied to construction and manufacturing could remain structurally strong for years. Add to that the growth in renewable energy infrastructure and electrification projects around the world, and industrial metals become even more important. Nexa sits directly inside that ecosystem. The company operates mines, smelters, and logistics assets that give it integrated exposure across the value chain. That vertical integration is important because it gives the business more control over operations and helps reduce dependence on third parties. Now let's talk about why value investors are paying attention right now. According to recent analyst data, Nexa Resources currently trades at a price-to-earnings ratio of roughly 13.82. Compare that to the S&P 500 average near 23.71, and you immediately see why investors focused on valuation metrics are interested. A single-digit earnings multiple on an established mining operator is the kind of thing that makes deep value investors stop scrolling and start researching, but valuation alone is never enough. A stock can be cheap for a reason. Sometimes businesses deserve low valuations because earnings are collapsing, debt is excessive, or long-term demand is fading. So the real question becomes this: is Nexa simply cheap, or is the market potentially mispricing future earnings power? That is where the earnings revisions become extremely important. Analysts recently increased their current year earnings expectations for Nexa by more than 22% over the last 60 days. That is a meaningful revision. When analysts begin raising earnings estimates aggressively, it often signals improving operational performance, stronger pricing conditions, improving production expectations, or better cost controls than previously expected. And remember, earnings estimate revisions matter because Wall Street constantly reprices stocks based on future expectations, not past performance. If expectations rise faster than the stock price, valuations can suddenly look extremely attractive. Another thing investors should pay attention to is how cyclical industries can create opportunities during periods when sentiment remains weak. Mining companies often experience dramatic swings in valuation because investors become overly pessimistic during downturns and overly optimistic during booms. That creates openings for disciplined investors willing to buy quality operators before broader sentiment shifts. Now obviously, mining is not risk-free. Commodity prices fluctuate constantly. Operational costs can rise unexpectedly. Political risk matters in mining jurisdictions. Environmental regulations can change. Currency movements can affect profitability. And global economic slowdowns can reduce industrial demand. Those are real risks. But here is the counterpoint. The world still needs metals. Infrastructure still gets built. Industrial activity still requires raw materials. Manufacturing still depends on supply chains. And replacing large-scale mining production is not simple or fast. Building new mining capacity can take years, sometimes decades. That means supply constraints can become significant when demand accelerates. And one thing many investors underestimate is how difficult it is to bring new mines online globally. Environmental approvals, political hurdles, financing requirements, labor issues, and construction timelines all create bottlenecks. That complexity can actually strengthen established operators already producing at scale. 𝗟𝗂 also benefits from geographic diversification across multiple operations rather than relying entirely on a single mine. That helps reduce operational concentration risk. Now let's zoom out for a second and think like long-term investors. One of the biggest mistakes investors make is assuming innovation only happens inside flashy technology companies. But real global economic growth also requires physical infrastructure, industrial production, transportation systems, energy grids, manufacturing facilities, and construction materials. All of that requires metals. And when you own a profitable mining operator trading at a compressed valuation during a period where industrial demand may strengthen over time, you potentially position yourself for both earnings expansion and valuation expansion simultaneously. That combination is powerful, because if earnings rise while the market also decides the stock deserves a higher multiple, the upside can compound quickly. And here is another overlooked factor. Many institutional investors rotate into value stocks during periods of economic uncertainty or when high-growth stocks become overextended. If market leadership broadens beyond expensive momentum names, lower valuation industrial and resource companies can suddenly attract significant capital flows. That does not mean 𝗟𝗂 becomes the hottest stock in the market overnight, but it does mean the stock may not need perfection to outperform from current valuation levels. Even modest operational improvements combined with stable commodity pricing could create meaningful upside over several years. And psychologically, this is where patient investors often gain an edge. Most people want immediate excitement. They want explosive headlines every day. They want stocks constantly dominating social media feeds. But wealth creation often happens quietly through businesses generating cash flow, surviving cycles, improving operations, and compounding over time while investors look elsewhere. 𝗟𝗂 fits that type of setup more than the typical speculative story stock. Another thing worth discussing is why low valuation stocks can outperform dramatically during certain market environments. When interest rates remain elevated or economic uncertainty increases, investors begin paying more attention to actual earnings and cash generation instead of pure future promises. That tends to favor businesses already producing profits today. And again, 𝗟𝗂's earnings multiple remains far below the broader market average. That valuation gap creates room for re-rating if investor sentiment improves. There is also the inflation angle. Commodity-related businesses sometimes benefit during inflationary periods because hard assets and raw materials become more valuable as replacement costs rise. Mining operations tied to industrial metals can become strategically important during those environments. Now, does this mean 𝗟𝗂 is guaranteed to skyrocket? Absolutely not. No stock is guaranteed to succeed. Commodity cycles can reverse quickly, operational challenges can emerge, global growth can weaken, and mining stocks can remain volatile for long periods. But value investing is not about finding certainty. It is about finding situations where the potential upside meaningfully outweighs the downside relative to valuation. And when you combine a low earnings multiple, rising analyst expectations, industrial relevance, and exposure to long-term infrastructure demand, you begin to understand why investors are paying attention to 𝗟𝗂 resources right now. One thing experienced investors learn over time is that some of the best opportunities appear when businesses look boring on the surface but quietly improve underneath. That is especially true in industries tied to the real economy, because while headlines constantly shift between trends, narratives, and short-term market noise, the global economy still depends on industrial production and raw materials every single day, and businesses supplying those essential inputs can become very profitable over long periods when purchased at the right valuation. 𝗟𝗂 may not dominate financial television every day, but sometimes the strongest investments are the companies investors are not paying enough attention to, while fundamentals quietly strengthen in the background. And right now, the combination of low valuation metrics, improving earnings expectations, and industrial relevance makes 𝗟𝗂 one of the more interesting value stock setups to watch. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on this list operates in an industry that is becoming more important with every passing year because of one unstoppable force that investors cannot ignore: demographics. The company is Healthcare Services Group 𝗟𝗑, ticker symbol HCSG. Now this is where things get very interesting from a long-term value investing perspective, because Healthcare Services Group is not a flashy company. It is not trying to dominate headlines with artificial intelligence announcements or futuristic product launches. Instead, this business focuses on something much more practical and much more consistent. It provides housekeeping, laundry, dining, and nutritional services to healthcare facilities across the United States. And at first glance, some investors may underestimate how important that actually is. But think about the scale here. Healthcare facilities cannot function efficiently without sanitation, nutrition management, infection control support, dietary planning, and operational consistency. These are essential services tied directly to patient care quality, regulatory compliance, and day-to-day healthcare operations. In other words, this business sits inside the operational backbone of long-term care facilities and healthcare institutions. That gives Healthcare Services Group a business model tied to recurring demand rather than consumer trends or discretionary spending cycles. And the long-term demographic setup behind this industry is massive. The aging population in the United States continues growing steadily. Every year, more people enter age brackets requiring assisted living, rehabilitation services, long-term care support, and healthcare facility services. That means demand for healthcare infrastructure and facility operations could continue expanding for decades. This is not a temporary trend. It is a structural demographic shift, and businesses positioned inside those long-duration trends often become stronger over time because demand compounds gradually year after year. Now let's talk about why HCSG appears on value investors' radar today. One of the key reasons is earnings momentum. Analysts recently raised their current year earnings estimates for Healthcare Services Group by more than 16% over the past 60 days. That matters because earnings revisions often signal improving operating conditions or stronger execution than the market previously expected. And for a service-based business operating in healthcare support, improved earnings expectations can reflect better contract performance, operational efficiency improvements, labor stabilization, margin recovery, or expanding client demand. Remember, this company operates in an industry where consistency matters tremendously. Healthcare institutions are not constantly changing providers every few months. Reliability, compliance, staffing capabilities, and operational trust become major competitive advantages over time. That creates stickier business relationships. And sticky relationships are incredibly valuable in investing because recurring contracts create revenue stability. Now, another reason Healthcare Services Group is interesting is because the company exists in a market segment many investors completely overlook. The stock market often overprices exciting narratives while underpricing operationally important businesses that quietly generate steady cash flow. That disconnect can create opportunities, especially when investors become overly focused on short-term momentum trades and ignore businesses benefiting from long-duration demand trends. And here is another important point. Healthcare support services are not optional during economic slowdowns. Even during weaker economic conditions, healthcare facilities still require sanitation, dining operations, and support staff. Patients still need care. Facilities still need to operate safely. Regulations still need to be met. That defensive element can make healthcare-related service companies more resilient than many cyclical industries. Now, obviously, Healthcare Services Group still faces challenges. Labor costs remain one of the biggest issues across healthcare and service industries. Wage inflation can pressure margins. Staffing shortages can affect operational performance. Healthcare facilities themselves can face reimbursement pressures and financial stress. Those are legitimate concerns investors should monitor closely. But one reason analysts may be becoming more optimistic is because operational environments can improve meaningfully once labor markets stabilize. And when businesses with recurring revenue models improve efficiency even slightly, profit margins can expand faster than many investors expect. Another thing worth paying attention to is how smaller operational improvements compound over time in service businesses. If the company improves staffing efficiency, reduces contract turnover, strengthens client retention, and controls expenses more effectively, earnings growth can accelerate gradually year after year. That kind of slow compounding may not generate daily excitement on social media, but it can create meaningful shareholder returns over long periods. And one of the biggest advantages value investors have is the willingness to look where others are not paying attention. Because while speculative traders chase volatility, long-term investors often focus on businesses serving essential needs with durable demand. Healthcare Services Group fits that description extremely well. Now let's step back and think about the broader healthcare system. As populations age, healthcare facilities face increasing pressure to improve efficiency while maintaining quality standards. Outsourcing specialized operational services can become increasingly attractive because it allows facilities to focus more directly on patient care. That trend potentially strengthens the long-term role of companies like HCSG. And if the company continues improving execution while benefiting from demographic demand tailwinds, the market may eventually begin assigning a higher valuation to the business. That is the core idea behind value investing. You identify businesses where current market expectations may be too low relative to future earnings potential. Another thing investors often miss is how valuable operational expertise becomes in industries requiring compliance and consistency. Healthcare support services involve sanitation protocols, food safety standards, nutritional management, staffing coordination, and facility-level execution across multiple locations. That operational complexity creates barriers to entry. It is not easy to replicate large-scale healthcare support networks overnight, and companies that build long-standing institutional relationships often strengthen their competitive positioning over time. Now, one thing I personally find interesting about Healthcare Services Group is how closely the business aligns with unavoidable societal demand. People may reduce discretionary spending during tough economies. They may delay vacations or large purchases. But healthcare support needs continue regardless of economic cycles. That creates a more stable demand foundation than many industries have. And stability matters when building long-term portfolios, especially during periods when broader markets become volatile. Now, here is something many newer investors underestimate. You do not always need explosive revenue growth to generate strong investment returns. Sometimes all you need is a stable business purchased at a reasonable valuation that steadily improves profitability and compounds over time. That is often how disciplined wealth creation actually works. The market tends to reward businesses that demonstrate operational consistency, earnings growth, and resilience over long periods. Healthcare Services Group has the type of business model where small improvements can significantly impact investor perception. If margins recover further, earnings estimates continue rising, and healthcare demand remains strong, the stock may look far more attractive to institutional investors than it does today. And when institutional money begins rotating into undervalued defensive businesses, re-ratings can happen surprisingly fast. Now let's also discuss investor psychology for a moment. A lot of people get trapped constantly searching for the next revolutionary story stock while ignoring the power of boring businesses solving real-world problems. But boring businesses can become incredible investments when purchased at the right valuation, especially when they serve industries with durable long-term demand. Healthcare Services Group is not dependent on consumer fads. It is not relying on one viral product. It is not dependent on speculative technology adoption curves. It operates in healthcare support services tied directly to ongoing facility operations. That predictability can become very valuable over time. And again, the demographic backdrop supporting long-term healthcare demand is incredibly powerful. The aging population trend is not reversing anytime soon, which means healthcare infrastructure, operational support, dietary services, and facility maintenance needs are likely to remain extremely important for decades. Now, does that guarantee massive returns? Of course not. Every investment carries risks. Contract losses can happen. Operational execution matters. Cost pressures can emerge. Healthcare reimbursement environments can shift. But when you evaluate value stocks, the key question becomes whether the market is underestimating future business durability and earnings potential. And based on rising analyst expectations, improving operational outlooks, and strong long-term demographic trends, Healthcare Services Group is becoming one of the more interesting healthcare-related value plays investors are watching right now. The company may never become the most talked-about stock on financial television, but sometimes steady businesses serving essential industries quietly outperform while everyone else chases excitement. And for long-term investors focused on durable demand, recurring revenue, and demographic tailwinds, HCSG deserves serious attention. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The final stock on this list operates in one of the most misunderstood sectors in the market today because many investors still associate smaller banks with instability, slowing growth, or economic uncertainty. But the reality is that well-managed regional banks can become incredibly powerful long-term compounders when they focus on disciplined lending, strong customer relationships, and consistent profitability. The company is Shore Bancshares Inc., ticker symbol SHBI. Now, what makes regional banking interesting from a value investing perspective is that these businesses are deeply connected to the real economy. They finance homes, businesses, local development, commercial activity, and community growth. They operate close to customers, often build long-term banking relationships, and generate earnings through lending spreads, deposits, and financial services. And during periods when larger financial institutions dominate headlines, smaller regional banks can quietly trade at very attractive valuations. That is where 𝗗𝗑 shares becomes compelling. According to recent analyst data, 𝗗𝗑 shares currently trades at a price-to-earnings ratio of roughly 10:41. Compare that to the broader market average near 23.71, and once again you see a substantial valuation gap. That low valuation immediately gets the attention of value-focused investors searching for businesses with stable earnings power trading below broader market multiples. But the more important question is whether the company can continue growing profitability over time while maintaining disciplined banking operations. And this is where earnings expectations become important again. Analysts recently increased their current year earnings estimates for 𝗗𝗑 shares by more than 7% over the last 60 days. Now 7% may not sound dramatic compared to some high-growth technology stocks, but for a regional banking institution, upward earnings revisions can carry significant meaning. It suggests improving confidence in loan performance, operational stability, deposit trends, or profitability outlooks. And when you combine improving expectations with a single-digit earnings multiple, the setup becomes very interesting from a valuation perspective. Now, one thing investors need to understand about regional banks is that trust matters enormously. Banking is relationship-driven. People and businesses want reliable institutions that understand local markets, maintain consistent service, and operate with financial discipline. Regional banks often build strong community connections that larger institutions struggle to replicate at the same level. That relationship advantage can support customer retention and long-term stability. Another factor worth paying attention to is the interest rate environment. Over the past few years, many investors became extremely nervous about banking stocks because rising interest rates created uncertainty around loan portfolios, unrealized losses, and deposit competition. And those concerns were not irrational. Some financial institutions faced serious pressure. But periods of fear can also create opportunities because the market sometimes punishes entire sectors without properly distinguishing between stronger and weaker operators. That is often where value investors step in. They look for businesses that may have been unfairly discounted relative to their actual long-term earning power, and 𝗗𝗑 shares appears to be one of those companies drawing increased attention because its valuation remains compressed while earnings expectations improve. Now let's zoom out and think about the bigger picture. Banking remains one of the foundational pillars of economic activity. Businesses need loans, consumers need mortgages, communities need financing. Economic development requires capital access. Regional banks play an essential role inside that ecosystem. And despite all the fintech innovation happening globally, traditional banking relationships still matter tremendously, especially in local and regional markets. Now obviously, banking is not risk-free. Credit quality matters. Loan defaults can increase during recessions. Deposit competition can pressure margins. Regulatory environments can shift. Interest rate volatility can affect profitability. These are serious factors investors must monitor carefully. But here is where disciplined management becomes critical. Strong regional banks survive difficult environments by maintaining conservative lending practices, managing risk effectively, and building diversified customer relationships. And when investors buy those businesses during periods of depressed sentiment, the long-term returns can become very attractive. Another important point is that lower valuation financial stocks can sometimes experience powerful re-ratings once economic fears begin stabilizing. Because if investors become more confident in the banking sector overall, stocks trading at very low earnings multiples may suddenly attract renewed institutional interest. And again, 𝗗𝗑 shares currently trades at a valuation far below the broader market average. That gap creates room for upside if sentiment improves. Now, something I think investors should always remember is this: the market constantly swings between fear and optimism. During optimistic periods, investors overpay for excitement. During fearful periods, they sometimes undervalue stability and durability. Value investing is about identifying those moments where perception and reality may no longer align. And with 𝗗𝗑 shares, the market appears cautious while analyst expectations continue improving. That combination deserves attention. Another reason regional banks can become compelling long-term investments is because they often benefit from local economic growth over extended periods. As businesses expand, communities develop, and commercial activity increases, banks serving those markets can grow alongside their regions. That creates gradual but meaningful compounding opportunities over time. And compounding is one of the most important forces in investing, not overnight gains, not short-term speculation, compounding. Steady earnings growth combined with disciplined capital management and attractive starting valuations can produce remarkable long-term outcomes. Now let's connect all three companies discussed in this video. Nexa Resources operates in industrial metals tied to infrastructure and manufacturing demand. Healthcare Services Group benefits from demographic shifts and healthcare operational demand. 𝗗𝗓 Bancshares participates directly in financial activity and regional economic growth. Three completely different industries, three different business models, but all three share something important in common. They appear undervalued relative to broader market multiples, while analysts increasingly expect stronger earnings performance. That is exactly the kind of setup value investors constantly search for. Businesses with real operations, durable demand drivers, and improving fundamentals trading at valuations that leave room for upside. Now, does every value stock succeed? Absolutely not. Some remain cheap permanently. Some face operational challenges. Some never recover investor confidence. That is why research matters. But successful investing is often about probabilities, discipline, and patience, rather than certainty. And what makes these companies interesting today is that each one operates in sectors tied to essential economic activity rather than temporary trends. Industrial metals, healthcare operations, regional banking. These industries matter regardless of what happens on social media next week. Now, here is the bigger lesson many investors eventually learn. The stock market often rewards patience more than excitement. People love chasing momentum because it feels thrilling. But long-term wealth creation frequently comes from buying strong businesses when valuations remain reasonable and expectations stay low. That is the heart of value investing. And right now, these three companies appear to represent that type of opportunity, not because they guarantee immediate gains, but because the combination of low valuation metrics, improving earnings outlooks, and durable business relevance creates compelling long-term potential. Now I want to hear from you. Which business do you believe has the strongest long-term competitive advantage between Nexa Resources, Healthcare Services Group, and 𝗗𝗓 Bancshares, and which one would you personally feel most comfortable holding for the next 10 years? Let me know down in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.